Hello guys, in today's video I will be analyzing why the stock market continues increasing while the economy keeps getting worse and worse. Analyze some earnings reports and will also give you guys my expectations for next week's earnings for LuluLemon, Adobe and Chewy stocks. The S&P 500 is up 5.08% since Monday, the Dow Jones almost 7%. Airlines like American Airlines and Spirit more than 70%. Carnival and Royal Caribbean more than 30% in a single week. You know what's that? More than 30 to 70% in a single week. That is insane. And why does the stock market keep going up if the economy is not at its best moment right now and there are more than 42 million Americans out of work? That basically means that unemployment rate is at higher rates since the Great Depression. Normally, the stock market and the economy go in the same direction since they take into consideration corporate earnings and productivity. But as I said in my other videos, the stock market completely divorced the economy. That happened because the stock market is reflecting the future of big businesses or what people expect for the foreseeable future, which is to reopen the economy and go back to normal. On the other hand, economic data reflects only what happened in the past. How many people were out of work last week, how many new virus cases appeared, or which businesses closed or went bankrupt last week. What this tells me is that investors are expecting that after we fully reopen the economy, employment will bounce back. Also, investors saw last quarter results, which some of them were way better than expected, and are expecting companies to do way better next quarter since they were able to reduce costs during the pandemic, and that means more profits for the company. Another reason is that, as we all know, interest rates are really low right now. According to the Fed, it will remain like that for a long time. That means that companies and consumers are able to borrow money at a very low cost, increasing momentum in the streets. Also, that means that bonds deals are very low and investors have no other choice than to invest their money into stocks. Why? Well, people invest in bonds because they want income, but with the current environment, bonds are not providing much income. For example, the 30-year Treasury is sporting a yield of under 1%. You can just put your money into a high-yield savings account and get 1% or even more. Also, buying long-term bonds at this moment can be a bad idea since when interest rates rise back again, the value of the bonds will drop. So basically, investors have no other choice than to invest in the stock market since low interest rates usually lead to high prices in stocks. Also, the economy in the rest of the world has already gotten better faster than here. And that means that our companies can do businesses overseas without any restrictions. For example, Royal Caribbean opened their offices in China 2 months ago, while here in the US they are still closed. That means that they will probably start sailing sooner than expected in other countries before here in the US. As some of you may know, I started buying Lyft stock in February as well as Uber stock. Even though we're in the middle of a pandemic, although nobody's talking about it anymore, Lyft business has been growing in the past months as the economy started to reopen. They reported that rides increased 26% in May in comparison to April, but rides are still down about 70% in comparison with the same period last year. I mean, that is normal. There are a lot of workers that started working remotely and will continue like that for several months or even the entire year. Also, a lot of people are still in lockdown without needing to take a Lyft or an Uber to go anywhere. The company also already expects that their EBITDA loss for the next quarter will not exceed $325 million. Another huge thing is that Apple decided to cut iPhone prices in China. Last time that Apple did this, took a massive amount of market share and ended up beating their sales estimates. Could it happen again? Yes, it definitely could. People are not willing to spend thousands of dollars in China for a phone, especially after a pandemic. And I mean, having a huge discount would increase their demand. There is a big shopping festival in China coming up on June 18th, and they decided to reduce their prices because of the huge competition between e-commerce giants during this month. Also, OPEC and allies have agreed to extend oil production for an additional month to be able to balance global oil market. In my opinion, this was needed since it will help the energy industry to have a quick recovery unless we have a second COVID-19 wave. Now, Zoom reported earnings last week and oh boy, it was crazy. They reported a revenue of $328 million, which is an increase of 169% in comparison with the same quarter last year. Also reported an increase in net income of 1,122%, obviously beating expectations. Their cash and cash equivalents increased from $283 million to $488.6 million. That is a whopping 94% increase in cash. The company reported a total current asset of $1.72 billion and a total current liabilities of $1.03 billion, which made their current ratio to drop from 3.28 to 1.72 since January. Even though it dropped almost 50%, they are still very well positioned cash-wise. Also, they reported a total asset of $2.07 billion and a total liabilities of $1.16 billion, increasing their total debt to asset ratio from 0.35 to 0.56, meaning that now they have 56% of their assets financed with debt. Obviously, I was expecting them to have an amazing quarter since the majority of companies have their employees working remotely and needed a platform like Zoom to communicate on a daily basis. The big question is if all of those companies that started paying for this service will continue after the economy reopens. I do think that a lot of them will keep paying it since they have noticed how effective people have worked from home, but others will definitely cancel it. Still, the stock might continue going up and up over the year as the pandemic continues, but for me, it is still overvalued. Zoom was one of the companies that has benefited the most during the pandemic and could continue like that. For the next week, we have several companies reporting earnings such as Chewy, GameStop, AMC, LuluLemon, and more. For this video, I will give you guys my expectations for Chewy, Adobe, and LuluLemon stock. Chewy is a relatively new online retailer for pet-related products. It is an exponential growing company that has never been profitable, although its net loss has been decreasing year over year. Over the last 3 years, their revenue has increased at a rate of between 35 to 60%. Something that I don't like about this company is their balance sheet. They have a total asset of $932 million and a total liability of $1.33 billion, meaning that they are operating in debt. Still, because of stay-at-home rules, I can see them reporting an increase in revenue once again, since e-commerce sales increased in every company since the pandemic started. Next, Adobe stock. You all know that Adobe is the market leader in digital media space. They have been exponentially growing year over year, as you can see. Their revenue has been increasing at a rate of 23 to 25% and a net income of 9 to 13%. Using their cloud-based platform, they have been diversifying into digital marketing services. Because of that, it is expected that Creative Cloud customers will start purchasing products from the Marketing Cloud to give their clients a way better and personalized experience that would definitely accelerate Adobe's revenue growth. They have a solid balance sheet with a current ratio of 1.23 and a total debt to asset ratio of 0.51. I do expect them to continue with its revenue and net income growth year over year. Lastly, LuluLemon stock. Even though the stock is overvalued in my opinion, they have an exponential growth year over year. As you can see, their PE ratio is way higher than the industry and it is expected to stay like that during the entire year. They have a very strong balance sheet with enough cash to sustain during the pandemic and an excellent online strategy. Obviously, one of the biggest risks you have while investing in this company is the competition with Nike, Under Armour, and any other premium activewear brand. As a lot of other retailers, I do think that they got hit hard by the pandemic since people stopped buying clothes and accessories as personal income actually went down. Because of that, I expect them to have a decrease in revenue and net income. Let me know in the comment section below what you guys think about my expectations. I do recommend you guys go and watch this video which are my 5 stock picks for May. And if you enjoyed this video, consider subscribing and smashing the like button for the YouTube algorithm. Thank you and see you next time.